Triple net properties, single tenant versus multi-tenant investments, and the pros and cons of each. And commercial real estate investors are constantly searching for investment opportunities that can generate reliable cash flow while also minimizing management responsibilities. And one of the most popular asset classes for passive investors is the triple net or NNN lease property. But should you invest in a single tenant triple net property or a multi tenant triple net shopping center? And each offers unique advantages and risks. And understanding the differences can help investors make better purchasing decisions and also obtain financing that aligns with their investment strategy. And as a commercial mortgage advisor with CommLoan, I help investors evaluate financing options across hundreds of lenders while also identifying the right loan structure for each property type. So what is a triple net lease? Well, a triple net lease or NNN lease requires a tenant to pay the property taxes and the building insurance and the property maintenance. And the landlord typically receives rental income while avoiding many of the operating expenses that are associated with traditional commercial properties. And that's because the tenants absorb most of the operating costs. And triple net investments often provide predictable cash flow with lower management responsibilities and long-term leases and stable income. So let's talk about single-tenant triple net properties. And single-tenant properties lease the entire building to one business. And some examples could include, say, a Starbucks or Chick-fil-A or a Walgreens or a CVS or a Dollar General or an AutoZone or a 7-Eleven or a Whataburger or any fast food restaurant, really, medical clinics, and even banks. And investors often refer to these as coupon clipper investments because of their consistent income. And the advantages are it's simple ownership with only one tenant and one lease, and minimal management, and traditionally long-term leases. And many leases range from 10 years to 15 years to 20 years. And some include renewal options that can extend the original occupancy for decades. Predictable cash flow. And most leases include scheduled rent increases along the way. Excuse me, which makes the income easy to forecast. Creditworthy tenants and national retailers often carry investment-grade credit ratings, which reduces the perceived investment risk in taking a lease for such a long period of time. But there's easier property management, and the tenant generally is going to handle all the repairs and the landscaping and the taxes and the insurance and the building maintenance. The disadvantages, though, are, the first is vacancy risk. So if the tenant leaves, rental income immediately drops to zero. And there are no additional tenants producing income. Tenant credit matters. So one struggling company can dramatically affect the property value. And market value depends on the lease that's in place. And the remaining lease term often influences the cap rate and the financing and the property value. And as the lease term shortens, investor demand may decline. So let's talk about multi-tenant triple net centers. And these properties include multiple tenants sharing one shopping center for the commercial building. So some examples could include a retail strip center or a neighborhood shopping center or a medical office plaza or a professional office building. So let's look at the advantages. You have multiple income streams, and if one tenant leaves, other tenants continue paying their rent, and your cash flow continues. There's lower vacancy risk. So diversification with multi-tenant centers really reduces your dependence on one single business. There's value add opportunities, and owners can increase rents and improve occupancy in the center and add tenants. They can also renovate the common areas, which in turn increases the net operating income. And a higher net operating income, or NOI, is generally going to increase your property value too. And they have strong long-term appreciation potential. And successful management can significantly increase your investment returns. The disadvantages, well, there's higher management requirements, and owners often oversee the common area maintenance or CAM charges. They have to maintain the parking lots and the roofs and the HVAC systems and the landscaping, and they have to coordinate with tenants. There's also lease expiration risks, and multiple leases could expire simultaneously. So renewal planning becomes critical. There's greater capital needs, and owners should budget for tenant improvements and leasing commissions and capital expenditures. So let's talk about financing triple net properties. And lenders evaluate several factors when financing triple net properties. And some key underwriting considerations can include tenant credit would be the first one to look at. And national credit tenants will generally get you more favorable financing. But the remaining lease term is another category too. And longer remaining lease terms often improve your financing options as well. The property location. So strong demographics and visibility will improve lender confidence in your property. Debt service coverage ratio, or DSCR. And lenders want sufficient property cash flow to be able to comfortably cover their debt payments. Occupancy. And higher occupancy generally results in better loan terms as well. So the question remains, which investment is better? Well, there really isn't a universal answer to that question. But single-tenant triple net properties may be better if you want passive ownership and stable cash flow with minimal management and long-term predictable income. And multi-tenants may be better if you want, say, higher returns and appreciation potential and portfolio growth, and you're comfortable with active asset management. And there's multiple income sources, and many experienced investors own both. Current market trends, and today's investors continue pursuing triple net properties because they offer inflation-resistant rental increases with stable cash flow and institutional quality tenants. And they're great for portfolio diversification. And there's strong lender interest. And cap rates vary considerably depending on the tenant quality, the lease length, the property age, the market conditions, and interest rates too. And working with an experienced commercial mortgage broker helps investors compare financing from numerous lenders instead of relying on just a single bank. So let's talk about how CommLoan can help you. And every triple net investment is unique. And through CommLoan's nationwide marketplace of more than 700 lenders, we help investors compare financing options for single-tenant triple net properties and retail centers and medical office buildings and mixed-use developments and office buildings and industrial properties and multifamily investments. And the right financing structure can improve your cash flow and increase your investment returns, but also position your portfolio for long-term growth. So whether you're purchasing your first triple net property or expanding a national investment portfolio, having access to multiple lending options can make a significant difference. So, final thoughts for the day. Triple net properties remain one of the most attractive commercial real estate investments that are available today. And single-tenant properties offer simplicity and stability, while multi-tenant investments provide greater diversification and also greater upside potential. It's important to understand the trade-offs and secure financing that's tailored to your investment goals. And that can help you maximize both your cash flow and your long-term returns. And if you're considering purchasing or refinancing a triple net property, I'd be happy to help you evaluate your financing options through CommLoan's nationwide lending marketplace. And that's it for the day. You can visit my website, billrapp.comloan.com, to start a pricing quote and also request a call back. And I look forward to chatting with you. Have a good day.